In this video, we're going to continue our discussion of inventory, but we're going to cover a number of different topics in this video. And the first thing I want to do is do a little compare and contrast between the methods that we've talked about. The specific identification method kind of stands on its own because we're not doing any sort of calculation. We're just following the item through the inventory. But with the first in, first out, what's in our ending inventory is pretty close to what the items our current cost is. And why is that? Well, because we sold the older stuff first. So the items that are left in our inventory are the things that we bought most recently. So again, our inventory, what's ending, likely matches the current price that we paid for the items. On the other hand, when we get to the last in, first out, it's actually not that case. There could be a disparity between what we are currently paying for items and what our inventory ending balance is. On the other hand, when it comes to cost of goods sold, the last in, first out method, because what we've sold is the most recent items we've purchased, what shows up on our cost of goods sold on our income statement, that pretty closely reflects what the true cost of the item currently is in today's market. And then of course we've got the weighted average method that kind of gives you a blended thing, and it smooths all those things out. So let's look at how those different items, the methods of calculation, will change both our cost of goods sold and the remaining inventory on our balance sheet. We have the specific identification, FIFO, LIFO, and weighted average. And again, the specific identification is kind of its own little thing there, but we see 4582. And then we have an ending inventory left of $1,408. Now we get to FIFO, and when we assume that what we sold was the items in our beginning inventory, we see that our cost of goods sold is $4,570. Our ending inventory is $1,420. The opposite being true under LIFO, and now you see our cost of goods sold is significantly higher. Look what that does to our gross profit. We're actually appearing as though we make less money because we chose the FIFO method and because the prices were going up. On the other hand, the FIFO method shows our inventory amount as being lower because what's left in our LIFO is being, lower inventory, because what's left in our inventory is really those items that we purchased first at an earlier time, possibly when prices were lower. And then we get the weighted average, which again sort of smooths out those fluctuations. But you can see that we will get a different gross profit figure depending on the inventory method we've chosen. Same holds true for the inventory figure on our balance sheet as well. So the IRS, of course, wants to have its hand in making sure that it gets its proper share of tax. And the IRS requires that if we use LIFO for tax reporting purposes, that we must also use LIFO in our GAAP accounting books. We can't use a different method for our book accounting when we use LIFO for taxes, is what that basically says. Now, we also want to make sure that what is stated on our books for inventory honestly reflects what our inventory value is. And if we've been if prices have gone down, for example, maybe we paid a lot of money for stuff that we bought early on and we're still sitting on that inventory, but now we could actually buy it for less than what we originally paid for it. We don't want to overvalue that inventory on our books. So we're going to make an adjustment at the end of our accounting period to adjust the value of our inventory to the lower of either, so we're going to record it at either the lower of cost, so, or what its current market value is to us. So what that means is if we bought it for lower than what we would buy it for now, we're still going to keep it recorded at the lower amount because we want to be conservative. We're not going to write up our inventory. We're only going to write it down if we need to. On the other hand, if what we could replace our inventory for today is less than what we actually paid for it and what's showing on our balance sheet, we need to make an adjustment and we need to write that inventory down to market value. We can do that in a couple ways. We can do it again specifically for each individual item. We can look at that in terms of major categories, or we can look at our entire inventory, and it's our choice. So in this example, we've got a motorsports retailer and they need to write down some inventory. They have 30 units, 20 of which are Roadsters, 10 are the Sprint model. And so what we paid for the Roadster was $8,500. What we could currently buy it for is $7,000. On the other hand, the Sprint is okay because we could actually we paid less for the Sprint than what we would have to buy them for today. So we're not going to mess with the Sprint, but we are going to write down the Roadster. And so we want to write down the Roadster to the $140,000 that it would cost us today, because otherwise the inventory value we have is inflated. So between these two, because we're going to leave the Sprint alone, we're going to write down the Roadster. That gives us an adjusted inventory amount of $190,000 from what had been the $220,000. So now we need to make a $30,000 adjustment to get from the book value of $220,000 down to the correct lower of cost or market value of $190,000. And the journal entry is, as it states here, we're going to do a debit to cost of goods sold, and we're going to do a credit to merchandise inventory. Now, sometimes we make mistakes. Mistakes happen. But when mistakes happen, they don't just impact the current financial statements when it comes to inventory. They can likely impact future financial statements as well. So depending on where the mistake is, or I guess how the mistake was made, depends on what is impacted. So if we've made a mistake in our ending inventory in terms of our count, we've either understated what we have or we've overstated. This will show you down here how that will then affect our cost of goods sold in year one and our net income in year one. So if we understated our inventory, then that means that we overstated our cost of goods sold. In other words, we attributed more to cost of goods sold than we should have, because it really should have been still sitting in ending inventory. That means that because we had more in cost of goods sold, our net income is going to be less. Now look at year two, and that's going to be an understatement on our cost of goods sold, because now our inventory is going to be off, and now our net income will be overstated. So those errors will actually reverse themselves in later periods. And I should say, and this is, we're talking about income statement. Let's look at balance sheet. Again, we've got the same understatement. So this means our assets are going to be understated and our equity is understated. Why is that? Why is our equity understated? Well, assets equal liabilities plus equity. So if we've understated our assets, for things to balance, the equity must be understated as well. Similarly, If there's an overstatement on ending inventory, it's going to result in an overstatement across the board on those. So we're going to talk about some ratios that we can use to monitor inventory and performance. And the first thing is the inventory turnover ratio. And this shows how many times during a period that we actually turn over our inventory. So it is the cost of goods sold over average inventory. So remember, this isn't ending inventory. We need to get your average. And how do you do that? You take the beginning inventory plus the ending inventory and you divide it by 2. And that's how you get your denominator for the inventory turnover ratio. There are a couple of ratios where you're going to have to use average. So just don't fall into the trap of just taking the ending or beginning, because you do have to make that calculation. But then the cost of goods sold, you can pull right off your income statement and calculate that. Now, then there's the days sales in inventory. So this tells us how much inventory that we have in terms of days sales. So it's ending inventory over cost of goods sold times 365, and this tells us how many days worth of sales are sitting in our ending inventory. Now we can use these figures to now analyze how well we do in managing our inventory. And I guess I want to sort of step back a second and talk about the management of inventory, because during the pandemic, we have seen all kinds of fluctuations. Normally, managers try to keep just enough inventory on hand to make sure that a customer can come in and find what they want, but not so much inventory that they got a lot of storage space that they now have to account for, pay for, basically. So many companies operated in terms of what's called a just-in-time inventory management, where they're just trying to keep enough in so that when the customer buys it, then something else comes in and takes its place, and there's never a stock out, but there's not excess inventory. And what we saw with that methodology is when there was a disruption in the supply chain, lots of empty aisles of no toilet paper. So I think that you will begin to see companies taking a little bit of a step back and feeling like they want a little bit more of a cushion or a pipeline on their inventory than they were previously comfortable having, because I think, all things being equal, having no product to sell is a worse scenario than paying some storage costs for some product. But we look at the comparisons here of Costco and Walmart, similar retailers, and we can see that Costco in the current year has 31 days of inventory sitting in its warehouse, whereas Walmart has 41 days of inventory. So given a pandemic, Costco is going to run out of inventory before about 10 days before Walmart does. And then we've got last year, and they largely hold true on that 10-day cushion between the two of them. And Walmart will turn its inventory over an average of 8 times, which is slower because they're holding it longer than Costco does. So Costco is going to turn its inventory over more quickly, and that has stayed really constant over time for Costco, and mostly for Walmart as well. Now I'm going to stop here and go on to the next video to talk about these inventory methods using the periodic system.